Imagine this. China cuts the flow of rare earths. The United States slaps new tech bans. Wall Street calls it a bluff. And then the dollar starts to fall. Not slowly, relentlessly. 5 months straight, the United States just triggered a global panic. Not with more tariff war, but with a spreadsheet. In May, Washington quietly threatened a global tax war towards trade talks and forced American banks to absorb a bond market no one wants to touch. Behind closed doors, even allies are cashing out. And while Trump calls it negotiation, the markets are calling it a crisis in motion. So if China won't fold and the United States won't back down, what crashes first trade trust or the entire financial system? In a move that defied logic and diplomacy, Donald Trump claimed he made a fast deal with China to rescue Beijing from internal collapse, alleging civil unrest and mass factory closures without offering any evidence. Bloomberg, however, reports no such breakdown occurred, and China's April industrial output actually rose 6.2% year-on-year. What followed was a 90-day tariff suspension struck in Geneva, where United States duties fell to 30% and China's to 10%. But simultaneously, the Commerce Department imposed sweeping new bans on China's access to chip design software and chemical shipments, with Reuters confirming that even previously granted export licenses were suddenly revoked on May 29th. While Washington calls it a containment strategy, Beijing's silence suggests they see it as sabotage. And the real question is whether this rescue was ever about stability or a setup for collapse. Treasury Secretary Scott Bessent flew to Switzerland to prevent a market breakdown brokering a short-term truce that diffused $145 billion in reciprocal tariffs. Yet China's response was muted at best. According to CNBC, Beijing has not lifted its rare earth export controls or accelerated export licensing despite agreeing to do so in Geneva. Trade Representative Jameson Greer told CNBC, "We haven't seen the flow of some of those critical minerals," citing delays in rare earth exports essential to AI chip manufacturing. Meanwhile, China's Ministry of Commerce argues the restrictions follow international practice and defend their pace as necessary for dual-use review. This isn't just bureaucratic inertia, it's strategic ambiguity. If Bessent believed China would return the favor, the early signs suggest Beijing's holding its leverage and Washington scrambling to reclaim credibility. Wall Street traders have turned United States trade policy into a punchline with a serious profit margin. The takeout strategy, Trump always chickens out, coined by the Financial Times on May 2nd, describes how equities dive after tariff threats only to rebound when Trump walks them back. Case in point, the S&P 500 jumped 2.1% on May 28th, just after Trump delayed a planned 50% tariff on European imports. Vital Knowledge's Adam Kreitz-Fully noted that investors are becoming more comfortable with the White House's pattern, while Moody's simultaneously downgraded the United States credit outlook due to fiscal volatility. But here's where the trade gets risky. If Trump decides to prove he won't back down, this time markets that built strategies around his U-turns could be left exposed. This isn't just about stocks. It's about trust and the illusion that Washington still plays by rational rules. April's trade data didn't just disappoint, it collapsed. According to the U.S. Census Bureau goods imports fell nearly 20%, month on month, the sharpest drop ever recorded following the March Liberation Day tariffs. Consumer spending, which drives nearly 70% of U.S. GDP, slowed to just 0.1% growth in April, down from 0.7% in March, per the Bureau of Economic Analysis. That's not just softening demand, it's stall-out territory. Households who bulk purchase goods in the first quarter are now tapping into stockpiles instead of buying. And behind that slowdown, rising prices and uncertainty. The very tariffs intended to punish China are now hammering domestic consumption. But with U.S. exports also declining, the entire feedback loop of trade-driven liquidity is breaking down. If Washington's goal was to weaponize trade, it's now ricocheting back at its own economy. Since peaking in December, the U.S. dollar index has fallen nearly 5%. And according to Bloomberg, June is poised to mark its fifth consecutive monthly decline. That's not a blip. It's a confidence erosion. The Institute of International Finance reports that foreign holdings of U.S. financial assets, primarily from Asia, total over $7.5 trillion, built on decades of trade surpluses recycled into U.S. bonds and stocks. But with Treasury yields volatile and confidence in U.S. fiscal management shaken by partisan brinkmanship, and erratic trade policy, even these historically sticky investors are reassessing. A weaker dollar should boost exports, but not when exports are collapsing and consumer spending is flatlining. The danger now isn't just capital outflows, it's narrative collapse. If the dollar loses its perception of strength, the entire architecture of global finance begins to wobble. And if foreign capital starts trickling out, how fast before it becomes a flood? Treasury Secretary Scott Bessent insists China will return to the table once Trump signals his preferences. But that belief has no observable basis. Beijing has yet to show any indication of capitulation. And even Japan, with 28% of its GDP tied to U.S. trade, hasn't caved under American pressure. Meanwhile, the U.S. trade deficit has ballooned to $1.2 trillion, up from $850 billion in 2021, according to the U.S. Bureau of Economic Analysis, a 41% increase in just 4 years. The country's net international investment position has plunged to negative $26 trillion, a historic low that reflects how deeply foreign entities now own U.S. assets. While Washington accuses others of exploiting the system, the irony is inescapable. America runs massive deficits, pays with printed dollars, and calls it strength. But what happens when the lenders stop believing in the borrower? In May, U.S. Treasuries recorded their first monthly loss of 2025, with total returns falling 1.2% across all maturities, Bloomberg reports. Since 2020, cumulative losses on long-duration bonds have exceeded 7%, even when accounting for coupon payments. Regional banks are now sitting on $413 billion in paper losses per Federal Reserve data, echoing the vulnerabilities that triggered the SVB crisis. As foreign demand dries up, these same banks may be forced to absorb new Treasury issuances, compounding their exposure. The catch: they can't mark the losses to market without shattering confidence or triggering solvency fears. Yet Bessent wants Wall Street to step in and buy more. This isn't just poor timing. It's a policy trap where the buyers are broke and the sellers are desperate. Buried inside Trump's proposed Big Beautiful Bill is Section 899, a clause so vaguely worded it could trigger capital controls without declaring them. The provision threatens higher taxes on companies or investors from any country with unfair foreign taxes determined unilaterally by the U.S. Treasury. Analysts at J.P. Morgan warn it could affect firms operating under OECD-compliant digital service taxes, potentially targeting allies like France or the UK. The bill arrives just as Treasury needs to auction an estimated $300 billion in new debt this quarter per Cibio forecasts. But with foreign participation in bond auctions falling to 57%, down from 72% a year ago, slapping penalties on global investors could backfire fast. If capital flows in fear of being trapped, the U.S. doesn't just lose investment. It risks turning its own currency into a quarantine zone. The Geneva Truce was supposed to be a diplomatic pivot, but nearly 3 weeks later, Beijing hasn't eased rare earth restrictions. Trump is threatening new auto tariffs on Europe, and Bessent's assurances of a Trump she call remain speculative. At the same time, U.S. consumer demand is faltering. Inflation remains at 2.3%, and bond auctions are being underwritten by increasingly fragile regional banks. Meanwhile, student visa revocations and export bans have widened the gap beyond trade into ideology. As Reuters notes, China's Ministry of Commerce is now urging the U.S. to correct its wrong practices, a phrase that in past disputes preceded retaliatory policy. If diplomacy requires dialogue and trade requires trust, the U.S. currently has neither. The question is no longer who will blink. It's whether either side still believes there's anything left to salvage. So now we're here on the edge of a trade truce, unraveling a currency slipping, and an economy pushing its luck. Treasury auctions are losing bidders, consumer spending is drying up, and foreign capital is quietly reassessing its loyalty. And still, Washington continues forward. Tariffs in one hand, threats in the other. Gambling on assumptions the numbers no longer support. But here's what you need to ask. If China refuses to bend, foreign investors step away, and U.S. banks absorb more risk than they can price, what breaks first? The bond market, the dollar, or the illusion of control? Drop your take in the comments. What happens if this standoff becomes the default, not the disruption? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.